All right, everyone. So finally, my higher time frame swing strategy. This strategy will finally be able to get you funded while working a 9 to 5, or if you wanted to just simply trade your own capital while working, then this strategy is also for you. So without wasting more time and without any more teasing, let's begin. Alright, so for the table of contents, I will not go over all of this. You can pause it and go over it through yourself, but I will talk about this little part real quick. So firstly, this strategy emphasizes achieving results by focusing on high time frames, such as the 4-hour chart. This approach minimizes noise and more accurately captures significant market trends. Here's how you can get started. So that is where you come in. You pause the video, take a look at all of this, or just look at the PDF itself, and it's in the description down below. And also, actually, before continuing on, please look at my intermediate to advanced market structure video. You have to look at it. It is a prerequisite. Okay, you cannot look at this video until you have seen that video. Okay. And another thing, if you haven't seen my SMC based video, part of my supply and demand series, you have to look at that as well. And the reason why I say that is because if you decide to trade this strategy without watching that video and understanding it, it's going to be very hard and difficult for you to find setups, and it's going to mess with your psychology. So please listen to me when I say look at those 2 videos. Okay. Now, if you've already done it, you can continue watching this video. All right. So let's move on. Okay, so for the first topic, we have to understand market movements. Let's begin. All right, let's start off with trend identification. Breakout structure. This is crucial in identifying the direction of the market. A breakout structure indicates a significant move where the market breaks past previous highs or lows, setting a directional trend. So let me zoom in for you guys real quick. All right, so here you can see the breakup structure and then this second breakup structure. Now, like a little note, I guess, 2 consecutive candles means stronger breakup structure. So if you see here, you had nice 2 consecutive candles, and then obviously you have that third one. Whereas here, you saw that the first somewhat beginning or sign of a breakup structure was this candle right here with this little wick breaking past. That is not very strong breakup structure. And then finally, these candles down here, that broke structure. Now, this isn't like a must-have, you cannot break rule, but I just recommend you use 2 consecutive candles. Okay, I've talked about this in my liquidity and inducement video. I would also recommend you watch that. Please watch all of that. But yeah, I have talked about it in that video. And here you can see also this example of what a good breakup structure looks like and what a not so good breakup structure looks like. So some people do use wicks as breaks of structure. I personally don't use them. You can if you want to, but I'd rather you don't. I'd rather you use at least one candle to confirm your breakup structure or change of character or a market structure shift. And yes, this strategy works with type 1 and type 2 structures. Now, you won't understand what this means unless you look at that market structure video or intermediate to advanced market structure video. So you have to look at it. I'm not going to explain it here because it'll just take more time. Now, counter movements, liquidity sweeps. These are movements where the price temporarily moves to extreme points to sweep stop loss orders or pick up liquidity before reversing direction. They are often traps that lead to rapid counter movements. Now, that doesn't mean that it'll reverse direction in terms of the entire market will shift. It's just reversing direction in terms of going back in its original trend. Now, you can have liquidity sweeps before, a change of character or a market structure shift, but for the main part, liquidity sweeps happen to, use it as fuel to continue in its original direction. Now, here is an example of a liquidity sweep, right? It wicks out, takes this little bit of liquidity, and then heads back up in its original direction. I believe the original image, if I could have added it, was the overall structure was going up and then down, and then it's going back up. But either way, let's just say it wasn't the case. Let's just say it originally was going down, right? The overall trend was going down. You can see this as a sign of liquidity being swept and then structure failing to go past this set of liquidity, or this wick, right? This would be our new lower low. In that case, price failed to show any signs of continuation down, and as you can see, it actually started going back up. All right, and now here you can see another example of the overall market direction being bearish, and here you can see sweeps in the direction of the trend can happen, but that can be due to something called inducement. So you can see small liquidity sweeps right in the direction of the trend. In this case, it's a bearish trend, but you can see sweeps right here and then another sweep right here. So sweeps can also happen in the form of a strong candle breaking upward and then continuing down or up depending on the trend, and then sweeping some more liquidity as it's going down. As you can see here, price swept some liquidity, went back up, and then finally started going back down again. So you can see signs of inducement on the 4-hour time frame, since that's really what this strategy is based off of. But you have to be very careful. All right, again, look at my liquidity and inducement video if you have not seen it. You have to see it. I'll link it down in the description below. I'll link everything you need to watch and then in the description. Okay, now next we have break of structure volume analysis. Volume as an indicator. Volume can verify the strength of a trend. High volume during a break of structure suggests strong market commitment to the new trend, while low volume may indicate a lack of conviction, possibly flagging a false break or weaker trend. So let's take a look at this real quick. When analyzing structure breaks, significant shifts in market structure, volume plays a crucial role. High volume breaks. When a structure breaks with high volume, it often validates the breakout, indicating that the movement might sustain in the direction of the break. Low volume breaks. If the structure break occurs on low volume, it suggests that the move might be substantial with a potential for a pullback or reversal, as market participants are not convincingly backing the new direction. So this is what I mean with some volume being broken. You have your, in this case, lower low here, market's coming down, you finally get that break of structure, but during that break of structure, you either have a fair value gap because of how far down or how fast price is being pushed, or sometimes you just have big candles, right? Something like that. And then the same thing applies for a bullish trend. And here you can see something like that. So high volume scenario, a high volume during the break of a previous low or high can imply that the break is a genuine break of structure, likely leading to a new trend direction. Low volume scenario, if this break happens on low volume, it might just be a sweep where price temporarily breaches a level only to revert back, continuing the previous trend. So here you have a high volume market structure shift or a change of character, because initially we were going up. You have a break of structure going down. You actually have two fair value gaps, or if you were to switch to a higher time frame, this would be an entire fair value gap on its own. Now the bigger the better. If you have big candle closures and big fair value gaps, then it's an obvious sign of a high volume break of structure. And as you can see here, high volume, this little bit of structure over here was broken with some fair value gaps, which indicates and confirms that the trend is officially shifting towards the downside. So again, we were moving up, started consolidating a little bit. What did price do? Break out, pause the first market structure shift, and then we have our second break of structure confirming, actually giving us a 90% confirmation that the trend has officially changed. Study this on the charts, open up a chart and see if you can find something similar. All right, now let's talk about the power of liquidity. I will touch up on liquidity a little bit here, but again, if you really want to get into it, definitely look at that video. All right, the importance. Liquidity is presented as a fundamental concept in this trading methodology, used for understanding market structure, determining trade direction, and making entry and exit decisions. It's important to view the market through the lens of liquidity, as institutional traders do. Here you can see in this example how you have liquidity being formed going down as a trend line, and then you also have somewhat equal highs, and then here you actually see liquidity get swept. And as a matter of fact, I'll make it easier for you. I'll zoom in a little bit more, right? See that set of liquidity here ended up getting swept. So now you have this, right? Almost like a sloped L. And then you have liquidity here that it needs to target. And what you have here, you have a order block or your supply zone, whatever you want to call it. I'll be referring to these zones as mainly order blocks, okay? The reason being is because sometimes you won't always need to be in a premium or even a discount when we're talking about demand zones to enter into our trades. All right, but we'll get into the whole nitty-gritty in a little bit. Now, as you can see, this set of liquidity needed to get taken out. What did price do? Tapped into it, and then finally went down, taking out this low here and this low here as our targets of liquidity. It's not insanely difficult. This concept is nothing crazy and it's nothing new, but once you get good at spotting this, I promise you, your trading will change. All right, let's talk about the different types of liquidity. Liquidity will look differently to you, but as long as you can spot it, or you can spot some kind of form of liquidity, you will be ahead of 90% of traders. Here are a few to study. So the most common that you'll hear is something like double tops, advanced triple bottoms, trend line liquidity, etc., etc. I'm going to be honest, these aren't very, very common. Okay, they are somewhat common, but not extremely. And even if something like this does show up, it's not going to look this neat. Okay, but again, liquidity might look different from what I determine and see as liquidity to what you might determine and see as liquidity. But as an example, this right here is all liquidity. This is like a form of trend line, right? All this liquidity needs to get taken out. And as it was breaking structure towards the downside, it was also taking out liquidity, or it was taking out those lower lows. And those lower lows turn into a form of liquidity until we finally get that change of character or break of structure. Let me zoom in for you a little bit here. Right, so here you can see that first change of character, and then we had that second break of structure. Price pulled into this order block, and then finally took off, taking out this set of liquidity. All right, so when it comes to liquidity, you have to learn to be adaptable. You have to learn to be able to say, okay, this looks like it might be liquidity, this looks like it's already been swept, so on and so forth. Okay, now it's going to take some time, and what I recommend that you do is backtest. Okay, backtest. I don't care who says backtesting is not useful. Whoever says that, honestly, is probably not even an actual trader. And I've heard, you know what, I'm just going to call him out. I mean, I've heard of what's that guy's name, Casper SMC, talk about how backtesting is not useful. All right, that is just so ridiculous to me. It is so dumb. So that makes me wonder if this guy's actually even a trader, which I'm pretty sure some people have exposed him for using like demo accounts, but I'm not going to try getting into all that. All I'm saying is backtest. All right, backtest. Okay, and here are some more examples that you can look at of liquidity being used. So here you can see some liquidity as a form of a trend line, right? So you see it's opening up, right? And then what does liquidity do? Come down, taps into the order block, and then eventually it goes up and takes out this high, or at least supposed to target that high. Here's another set of liquidity. Let me zoom in for you, right? In the form of a M pattern, right? Or that double top. You see it here. Price finally sweeps it up here, taps into the order block, comes down, and then here, not much or any liquidity present. Now this is actually very important. This is why I added it into here. Reason being is because sometimes liquidity is not always going to be present, and what I mean is it's not going to be fairly obvious. And if something is fairly obvious, that means because there's usually a lot of that, right? And in this case it wasn't. Usually it would be this low. In this example, that would be the liquidity being swept. So my point is, you don't always need to have liquidity to trade, but I would say don't enter a trade if you don't see it, in my opinion. Okay, not unless you absolutely know what you're doing and you have added a few extra confluences to, in a sense, replace the one confluence that you would need, which would be liquidity, if you know that makes any sense to you guys. Next, here you have some breaks of structures, right, towards the upside. Price comes and generates some more liquidity here, right? Bunch of liquidity, and you actually can trade this while it's forming, although I'd be very careful because, well, you can get stopped out. Like for instance, this area right here clearly wicked out of this order block. All right, this order block that would have been marked up, it got wicked out and then finally continued in the original direction. Very important. It actually relates to type 1 and type 2 market structure that I again touch on the intermediate to advanced market structure video. Now real quick, wick out but did not close through with volume, so still bullish. Just because price wicks out through the order block, that does not mean the order block is invalidated. All that means is that there was a sweep of liquidity and then price decided to take off. This can happen, guys. So be very careful, because with this trading strategy, you will be using limit orders as your main form of entry. But you shouldn't get discouraged, because you can also re-enter, or if you want, you can use some other entry confirmations if you want to avoid stuff like this, which I will touch on in this video. But yes, something to definitely keep in mind. Here again, some common patterns of liquidity. You'll have another trend line or form of trendline liquidity, and then you'll have it tap into a fair value gap and then go up and target the first high here, right, or this major high. Now, the reason why I included only a fair value gap is because with this strategy, if you don't want to use order blocks as your main entry or main confluence, you can use fair value gaps only, but you have to make sure you have at least everything else. Okay, please make sure you have at least everything else. So if you're a fair value gap trader, you can also trade this strategy with fair value gaps, although that is not how I intended for this strategy to be used as. So let's move on. Okay, I actually decided to add one more example here. So you have the overall structure as being bearish. Please make sure you're trading with the trend, because this might look like there's a shift in character or a shift in trend, and you might actually be looking for buys and you end up getting stopped out. So please make sure you are trading with the structure. Okay, if the overall structure is bearish, only enter shorts. If the overall structure is bullish, only enter in buys. Okay, very, very important. So please refer back to this image if you have some kind of doubt or question or how it would look like. All right. Alrighty, so let's get into fair value gaps / imbalances. So fair value gaps and imbalances are central concepts in any trading methodology. They are used to understand market structure, determine market direction, establish trading bias, identify entry points, and manage trades. Let's dive in a little deeper. So again, very important, trade with the trend. So trading strategy application, entry points. Fair value gaps can be used as your only source for potential entry and exit points for trades. If you decide that waiting for price to reach your order block isn't for you, then try using only fair value gaps. So yes, ladies and gentlemen, if you don't want to use order blocks, you can just use fair value gaps only. And here is actually an example of a fair value gap being used as its only source of entry. Right, but we're trading with the trend, and as you can see, it entered into an area of discount. Now, trade management, trailing your stop loss. Trail your stop loss underneath an order block and imbalances as the trade progresses and as you see price reacting positively from them. A lot of grammatical errors. Sorry about that, guys. Anyways, so yes, you can manage your trade by trailing your stop loss with fair value gaps. So if you see price is leaving big fair value gaps and it's not retracing into it, you can move your stop loss somewhere in that area. Now, in my supply and demand series, I actually went over how to manage your trades. So if you want to take a look at that, and you'll probably have a way better concept or idea of how to manage it. I personally just set my stop loss and I don't move it when it comes to this strategy. I literally just set it and forget it. That is the beauty of this strategy. All right, you can definitely look at that video or that series. Again, I'll link it down in the description. Next, challenges. The biggest challenge is figuring out which fair value gap to take. One of the ways I solve this issue is by simply watching how price reacts when it reaches that fair value gap. Ask yourself these questions. Did price have a quick rejection? What kind of candlesticks pattern appear? Was there some form of market structure shift followed by a breakup structure? Am I trading with the trend, etc.? Now, something I should add is in some pairs, it's better to trade in a discount or premium area, depending on the trend type, rather than just taking a trade that matches the recently discussed criteria. Why? Because some pairs deliver price more efficiently that way and some don't. So when trading with fair value gaps, I would recommend that you watch out and look at how structure reacts on that specific trading pair or instrument. Because again, some retrace into fair value gaps that are in premium or discount areas and some don't. So you'll have to adjust your strategy according to that. Now here you can see a really nice trade, right? There's an order block, a fair value gap present, price taps into it, and it targets our first TP. This is a quick, a little bit of foreshadowing, if you know what I mean. Now here you can see how price reacts to fair value gaps only, right? Fair value gap right here. This fair value gap did not overlap with an order block, or that order block right here. And as a matter of fact, let me zoom in a little bit for you here. You can see how price did not touch this order block that would have been marked out, which is why some people would prefer to react or trade off of fair value gaps. And as you can see, there was a quick rejection, strong candlestick movements going downward, which could have been used as an entry criteria. Now, another thing that you can do is use volumized fair value gap indicators, which again is one that I've shared on that market structure video. So take a look at it. And I talk about identifying these areas a little bit better, but you know, one of the ways I do identify them is how I just described them. Okay, so again, take a look at that video. So let's move on. All right, so let's get into order blocks. Order blocks are referred to as foundational elements in understanding market movements and setting up trading strategies. They provide key zones where significant price actions occur, helping traders make informed decisions regarding entry and exit points. The emphasis on volume and structure breaks when identifying order blocks highlights their robustness in trading methodologies presented in this guide. Really, I'm just yapping, guys. I just want to sound fancy. That's probably the only reason why I added this. Definition and identification. An order block, or OB, is usually identified following a break of structure in the price. This initial movement must be accompanied by significant volume to qualify as an order block. Without both of these conditions, a valid order block cannot be formed. You don't really need to have a fair value gap or a ton of volume, but in this case, I would say yes, you do. So, influence and strategy application. The presence of significant volume and an aggressive price movement suggests the potential formation of an order block. This order block is pivotal in trading strategies, particularly when determining the placement of pullbacks or Fibonacci retracements. Identifying an order block is essential as it significantly influences subsequent trading decisions. In other words, very important that you have volume in those order blocks. Mitigation of order blocks. Once the price reaches an order block, it is considered to be mitigated. Notably, an order block can usually be mitigated once, but there are times where price can retest that same order block to trick traders into thinking the order block is invalid and that it might not hold. But that can be a trick, and price ends up respecting that order block. Refer to example A. So for example A, here I'm going to zoom in a little bit for you. So as you can see, price tapped into it once. What did it do? Came back again and tapped into it twice. This OB is the final recent candle before the volume surge. It does not necessarily have to be a candle in the opposite direction. If the price action generates bullish volume, the OB can be either a bearish or bullish candle. It simply needs to be the last candle before the increase in volume occurs, or can be either. Yeah, I don't know what's wrong with me, guys. I don't know if I can't read or spell. Maybe it's both. So anyways, you don't have to use the last candle before the bullish candle or bearish candle. So I know that in supply and demand, we'll use, like for instance, we'll use the bearish candle before the bullish one when looking for a demand zone. And then for supply zone, I know you're looking for the last bullish before the bearish one. But really, just choose the one that you think makes more sense. I actually highlighted this big one right here, as you can see, with this like grayish box with a line here. And the reason why I did that is because you can actually use this big candle as an order block and put your limit order at the 50% of that order block, and you would have still gotten a really good entry. All right, and as you can see, some more liquidity here being formed, and that liquidity was also targeted. Very clean. Let's continue here. Challenges and identification. Initially, identifying order blocks may be challenging due to their subtle manifestations in price movements. However, with practice and experience, traders can develop the skill to quickly recognize these setups, enhancing your ability to respond strategically in live trading conditions. So please, guys, practice practice really does make perfect, okay? And let me just go over these next two examples real quick. So since price didn't overlap the previous bearish candle, then the bearish candle will be considered the order block, plus it has a fair value gap in it. So see, this little fair value gap in it, you could consider that as the order block. Now what I've noticed is, and this is actually something that I do and I've seen other traders do, is they'll actually use these two candles, for example, these consecutive candles, as an entire order block in itself. Why? Because if I were to go on a higher time frame, these two candles make one single candle. Doesn't matter if it's 2, 3, or 4. Sometimes they'll, use all 4 candles if there's 4 candles present in this case. But right here in this image, we'll have 2. But if there were 4 candles, you could also highlight all 4 candles. All right, it doesn't have to just be 1. And then see right here, I drew something called accumulation blocks. Now I don't know if anyone has actually coined a concept like this. I don't know. I don't know if someone else has done this or whatever. All I know is this is actually something I have used before, and I call this accumulation blocks. So these are small areas of accumulation that can be used as an order block, and no fair value gap or volume has to be present. A breakup structure is more than enough. So sometimes you'll have these little areas of accumulation, and then you'll see there's also a breakup structure followed by it. And notice how it's really hard to see, okay, well, where's the order block, or where's that last candle before the bullish one, or whatever. Sometimes it's not there. And really, as long as you have some liquidity, you can just use this as your accumulation block, right? Or as one of your point of entries. Just highlight it, put a limit order here, target whatever you're going to target, and yeah, you'll be fine. This is an actual thing that I use. It doesn't happen all the time, but when it does happen, I know automatically, oh, this is an accumulation block, I'll just use it. So just thought I would throw that in there for you. All right, I've added some more examples here. Give me that like and subscribe, guys. Give me a like and subscribe, because how many people do you know are giving these kinds of strategies away, and with all these examples? I mean, seriously, I'm going above and beyond here for y'all. So let's zoom in here. So an example, right? You have your accumulation block. It ends up getting swept. Order block's not valid anymore since structure failed to break through. And what I mean is it failed to break through up here. All right, we didn't get that second break of structure to confirm that change of character. So this accumulation block is no longer valid. And as you can see, price actually ended up tearing through both of them. Here you have a nice break of structure towards the upside. You have a fair value gap. Price already reacted to that fair value gap, so this can also be used as an order block. Didn't close under order block with displacement. All displacement is strong volume with a fair value gap in the middle. So yeah, this order block is still valid because price did not close under it. So yeah, you could still trade off of this. And here you have a breakup structure. Either one was possible. Reason why I say this is because a lot of us get a little discouraged and say, okay, out of all the order blocks, which one should I choose? I'm marking up 2 order blocks. Like, do I not know what I'm doing? That kind of psychology enters into you, and you start doubting yourself if you know what you're doing in this case, or if you think that this trading strategy isn't going to work, or whatever, right? I mark up sometimes more than 2, and I'm trying to see, okay, what will price do in one of these? Either one is possible. Price could have mitigated this one and came down into this one, right? Either one is possible. So when you have something like this, that is where I would recommend to not use limit orders and look for something like a candlestick pattern or another type of entry. Okay, again, I'll go over those different entry methods, but when you have more than one order block marked up, I would hesitate to use a limit order. But again, it's up to you. And here for our bearish scenarios. So yeah, you can see order block here, price came up, reacted to it, came down here, price came up, reacted to it. That's also another way to mark up structure if you like. There are many reasons to choose this order block. I know I would have taken this and probably would have gotten taken out, but that's okay. Now, why did I say that? It's because I'm not a perfect trader, and I will not pretend like I am. Some people would have marked this up as an order block and will more than likely entered off of it, and you probably would have gotten stopped out. But that's okay. You will get stopped out in this game. It is what it is. But we cannot get discouraged. We have to take the L and move on. Here, break of structure towards the upside, right? Or you could call this a sweep of liquidity. Why? Because there was a possible change of character. What did price do? Tap into this small little order block, went down, causing a second break of structure, indicating a change in trend. Here you have liquidity. Price taps into the order block above this liquidity and then continue going down. Pretty easy, pretty simple. All right, let's talk about Fibonacci retracement. So this tool aids traders by identifying potential reversal levels on the charts. These levels are percentages that mark how much of a prior move the price has retraced and will retrace. The effectiveness of Fibonacci retracement is highlighted in relation to market trends. It is particularly potent when the market is showing clear upward or downward trends. Like and subscribe, bozos. Okay, so here are the fib settings that I want you to copy. Very important. Okay, copy these settings. You will need them, okay, because these are going to be our take profit levels that you could use. All right, so for our take profit levels, you don't need to use all three take profit levels, just one is sufficient. I personally recommend that you use just one take profit until you've mastered the strategy and until you're more comfortable. And even now, I try not to use more than one take profit. It's just too much waiting. I am a little patient, but not too patient. So please understand that I'm not going to be using more than one take profit. All right, but again, it's up to you. So the first take profit level is very important because often the price won't reach the highest or lowest point of the trend. And what I mean is it won't always go past this low, right? So I'll explain in a little bit. And if you wait too long, you might end up getting stopped out of your position. So example with TP1. Notice how price reversed exactly at the 0.1 level. Now that doesn't mean this level will always save you, but it is really good at mitigating losses. Sometimes price won't actually always even reach the 0.1 level, but what I have noticed in my back testing is that it reaches it a lot and then it'll maybe pull back and then go back down to continue breaking that structure. But the thing is, I would much rather you just target this area. It's a lot simpler, a lot easier, and quite frankly, it's a real big lifesaver. So if you are going to use more than one take profit, you know, you could just move your stop loss to break even, take out 90% of your position, and then for that second take profit, you take out maybe the remaining out of the remaining 10% that is left, take out 5% of that, and then for your final take profit, take out the last 5%. So best for adaptability. You can use the fib tool in many ways. One, high probability order block. If an order block happens to be at your fib level, then choose that one. Number two, more than one order block. If there is more than one order block, choose the one closest to your fib level. No order block, no problem. If you can't find an order block, then simply use the fib level as your entry. So real quick, let me zoom in here for you. As you can see here, there's more than one order block. You could either set it at the 0.75, set your limit order here, or you can set it at top of this order block, the middle of this one, or in between these order blocks, or at the sort of higher end of this one, or in the middle. Doesn't matter. It's completely up to you. If you're a newbie and you just want to use the fib, just set it at the 0.75 and set this area or the 0.1 as your target. Okay, we don't have to complicate it if we don't need to. Very easy, very simple. All right, so let's talk about those entry confirmations. And again, if you haven't seen the supply and demand series on this specific part, I want you to click here. Okay, click here. I promise you won't regret it. Let's move on. Now, why so many? I've used all of these confirmations and have proven to be the best when making a custom trading plan. Depending on the type of trader that you are, can also affect on the type of entry confirmation you will end up using. And since there is a lot of discretion in trading, what works best for me may not work best for you. So I've included some options for you to choose and play with. Now, what do I recommend? For this strategy, I recommend using A, limit orders as the main form of entry. But if you want to take a little less of a risk, then I would recommend entry B by either using an engulfing candle or the first opposite candle that appears in case price wicks you out of the order block but doesn't close through it with momentum. I already talked about this. Now, I already talked about limit orders before, so you have to kind of be experienced already, guys, in trading in terms of just identifying market structure, liquidity, all that good stuff, because I'm not going to dive deep into all of this because I don't want to waste too much time into it. So I'm not going to talk about the candlestick patterns too much either. Like I said, if you see an engulfing candle, or maybe you just want to take the trade at the first opposite candle that you see. And what I mean is, like, if you're, for instance, if you're going to enter into a buy, the first opposite candle that you want to see is the first bullish candle. And if you're going to enter into a sell, the first opposite candle you want to see is a bearish candle. Now, I've already talked about all of these again in the video that I mentioned, but I actually added this extra one here, inverse fair value gaps. So once price inverts the fair value gap, you can enter at the close of that candle. So you have to find the most recent fair value gap, which in this case actually would have been this one right here. So let me zoom in here. It would have actually been here, but let's say you wanted to be safe, then you could have chosen the most extreme one. Once you inverse this area, you could enter off of that. Once price closes over it, bam, entry here, stop loss right underneath or wherever you want, and you're good to go. So hopefully that clears that part up. Now, what you can do if price fails to tag you in. My number one recommendation is to let price run and do its thing. Why? Because by the time you realize price isn't going to touch your POI, price already took off and you're too late. By the way, POI means point of interest. Now, if you're one of those people that don't care and still want to get in, then I recommend you at least wait for some kind of candlestick momentum indicating it might not reach your point of interest. Although this is still very risky because it might seem like price is trying to move in your favor, but then it might reverse on you seeking more of a premium or discount. You can also wait to see if price offers a second entry. So again, all the confluences are met here, right? And here, as you can see, price did not even tap into the fair value gap. But what can you do? Look for some momentum and say, okay, the price already swept liquidity. What's the momentum here? Oh, there's a fair value gap here, right? That got formed. Nice big bullish candle. I'm going to enter off of the fair value gap. You can do that. But here's why I say it's risky. You might have entered off of here, right? And let's just pretend that price didn't play out in our favor. Let's say you enter off here and you set your stop loss under this area. Price could come down and take you out, right? And then it says, you know what? Price might say, oh, you know what? I'm actually going to fill in this fair value gap, or I'm actually going to tap into this order block. Let me just retrace back down here. And what happens? You get stopped out. Price actually taps into this area and then moves into its intended direction. That's why I say if price didn't tag you in, even though it met all of your confluences, it's okay, guys. It is okay. The beautiful thing about trading is there will always be another opportunity. Always. There will always be another opportunity. Please do not get desperate. There will always be another opportunity. And something I wanted to also talk about is I put my limit order in the middle of this fair value gap and order block. Just thought that you guys might like to see something like that. That is also another way that you can enter. All right, let's move on. All right, so we are going to put it all together, guys. We're putting the strategy together, and hopefully we can get you guys funded and quit that 9 to 5. Okay, so here is your main trading plan. So number one, change of character or breakup structure. And what I mean by or breakup structure, I'm talking about if you're trading with the trend. But if you're looking for a change of character, make sure you're looking for that change of character and a breakup structure. So identify the direction of the market the best you can. Please guys, identify the market direction. Please do the best you can at doing it. You will avoid a lot of heartache by identifying the direction of the trend. And there are indicators for that as well. Number two, sweep of liquidity. A liquidity sweep is when price briefly moves beyond a structural point, like a recent higher low, before reversing or moving past it. Next, volume in your POI. We've already talked about this. Marking up order blocks. Mark up the order blocks that cause a structural break with volume. Fibonacci tool. Pull the Fibonacci retracement tool from the swing low up to the swing high, or the swing high to the swing low, depending on the trend, obviously. And see if your POI or order block aligns with it for a higher probability setup. Liquidity near your zone. Look for any liquidity resting near any of your zones, POIs, or order block for price to take out. The tradable assets. Now, with this strategy, diversification across multiple pairs are used to spread risk and increase opportunities for finding profitable setups. By monitoring multiple pairs, traders can select the best trading opportunities, ensuring that they're always in a position to capitalize on market movements. It's worth noting that the specific choice of which minor pairs or metals to trade may depend on various factors such as market conditions, personal preference, familiarity with specific currency pairs, liquidity of the pairs, trading hours out of line with your schedule, etc., etc. While I recommend a minimum of 10 pairs, you could potentially expand this list as you become more comfortable with this strategy and can manage more pairs effectively. Lastly, it's crucial to thoroughly understand each pair you choose to trade, including the factors that influence their movements and their typical behavior during different market conditions. This knowledge will help you apply the strategy more effectively across your chosen patterns. Guys, if you don't understand what I'm saying, just put it in ChatGPT and tell it to simplify it for you. I'm sorry, I just like getting fancy. You know, I just like it. Now, here are some of the major currency pairs that I recommend to trade it with. Lately, I have been messing with the US dollar and Mexican peso. Yes, guys, I'm Mexican. Not many people trade it, but it has some pretty consistent market structure. If you look at it from the 4-hour time frame, it's actually not a bad pair to trade. It's really not. I kind of have enjoyed messing with it, to be honest with you. So I'd take a look at it. And yes, you can use indices. I recommend US 30 and S&P 500. I don't recommend trading NOS with this. NOS 100, just I don't like it. I really don't like it. But you can try it. But it's just that these are the ones that I have seen to give the best results. So it's up to you. Okay, it's up to you. But yeah, guys, focus on this. Read this. Make sure you're understanding what I'm telling you. And backtest. Okay, please backtest. All right, so we're going to look at some A+ setups. So here's a bullish example, right? So we have a breakup structure or sweep of liquidity, whatever, and we're going in the direction of the trend, right? Because the overall trend is bullish. What do you have here? Some liquidity, right? You have some liquidity. We draw up a fib. We have a fair value gap and an order block. Set that limit order here. Target that first TP. Beautiful, right? Bearish example. Order block up here. We have that liquidity or trend line liquidity, whatever. What does price do? It stops us out the first time. But what did I say, guys? Look for a candlestick pattern. See this bullish one right here? Big bullish candle. All right, I enter off of that one. The risk to reward ain't all that crazy, but I entered off of it. It comes down here, taps into the 0.1 level. And then what does price do? It reverses on me. But I got my money back. See the power of the 0.1. Incredible. Here, change of character. Then we have our breakup structure. Liquidity gets formed. Fair value gap, order block right here. I put 0.75 of my position on this order block and then 0.75 again in that same area. Now, I recommend only risking around 1.5%. So yeah, you can put 0.75 here and then maybe another one right on that same area, or you can put 0.75 like on the fib here and then 0.75 on the order block. It's up to you. That's actually not that bad of an idea, so you can try that. So again, breakup structure, overall trend is bearish, and then what do you have here? Order block, taps into it, stop loss above this high, or you could have entered off with a fair value gap. Again, stop loss still would have been on this high though, and then target that 0.1, and as you can see, price still ended up going down, and I believe this is actually using the US dollar Mexican peso. So pretty interesting structure that it offers. Pretty interesting structure. Okay, so let's talk about some B+ setups. Now, what I mean by B+ setups is you might be missing a confluence or two. Max 2 confluences is what you can miss. All right, max. Please don't go over losing 2 confluences. All right. So here you have that breakup structure. You have liquidity that you can target if that's what you want to do. Liquidity gets swept. You have an accumulation block, right? Taps into it, goes into your TP. Okay, here, no order block used, but everything else was present. I used the fair value gap. I entered off of the 0.75. Bam, take profit hit. Here as well, breakup structure. Liquidity. No order block or fair value gap present, but everything else was, and the order flow was already bullish. Entered here. Bam, TP hit. Now, let me zoom in on this last one. I'm afraid you're not going to be able to see it very well. So, order block was present. Instead, fair value gap was, and candlestick was used as my entry. So, what do I mean is, Even though there was an order block, excuse me, up here present, price didn't tap into it. But instead, I saw how price reacted off of this fair value gap. So, as you can see, I entered here for a sell. Now, I also added this green one right here as an example of trading against the trend. So only change of character was used for trend confirmation, and then I used the candlestick pattern. So you can trade against the trend, but I really advise you to do it. But I only included this example for those of you that are not the brightest enough to trade with the trend. Okay, but as you can see though, there was a change of character. There actually was some liquidity down here, and you can trade into internal resting liquidity or IRL. I've actually talked about that in a video called, I think, Daily Bias and IRL to ERL Explained. It's by ICT. So definitely check that out if you want more information on it. But please don't trade against the trend. That's just foolish. Alright, so I know what some of you guys are probably thinking. What can I do to further improve this strategy? Well, you can actually use the weekly time frame. Utilize the weekly bias to guide your entry signals on the 4-hour time frame. Look for confirmation for the long-term or of the long-term direction to strengthen the validity of your trade entries. Ensure that the 4-hour signals align with the overall bias from the weekly perspective. So all it is essentially trading with the trend in reaction to what the weekly context give you. Order block on the weekly time frame, you see price going up and then finally goes down after tapping into it. So what could have you done? Short-term buying, all right, bought all the way up to the beginning of this order block here, and then start looking for sell setups on the long term. Nothing crazy, right? Now next is using volumized order block indicators. These indicators can help find order blocks with high volume in them, which can help narrowing your choices on which order block to go for if you have any doubts on which one to choose. I also recommend using a candlestick pattern with this. This is the link for this indicator. Now, I want to talk about it in a little bit more detail here. So, as you can see, price is giving me some volume here, right? The indicator saying, hey, this area right here, high volume. So what does price do? Come down, breaks through it a little bit, but it doesn't close under it with displacement. Barely any candlesticks. Barely any candlestick wanted to form here. Hence why you can trade even though it broke past the order block. I need to see displacement again. There needs to be high volume breaking through that order block. Hence why you can still trade with it even though it broke past it. And it wasn't even that big of a break. And you could have entered off of this candlestick right here, right? Targeting TP1. All right, let's talk about risk management. This is a very important part, so please do not skip it. Please don't skip it. Okay, so this is how I recommend risking your trades, right? So option 1, close entire position at first, take profit. Option 2 is take 90% off on the first TP and move stop loss to break even. Then take 5% off on the second TP. Don't move your stop loss. Lastly, take the remaining 5% off at the third TP. That is how I would do it. Now, I actually started thinking about it and I thought, you know what? It might be better that you guys do set limit orders here, 50% of the order block, and then on the 0.75 level. So half of your position here, half of your position here. All right. It'll give you a really, really good risk to reward, and you're kind of risking a little less, a little less in terms of being stopped out. All right. So please, I would much rather you follow that. Now, I prefer you go with option 1, especially if you are new to trading. But once you have mastered the strategy and everything surrounding it, then you can start using different forms of risk management of your own. If you go with option 1, you don't have to worry about managing your trade. It's been back tested and created to where you can set it and forget it, which is the main highlight of this strategy. Alright, so introduction to proprietary trading firms. I am in no way associated with the Funded Pro, by the way. Proprietary trading firms, commonly referred to as prop firms, present a significant opportunity for traders to amplify their trading potential. These entities provide traders with access to substantial capital, enabling them to execute trades on a larger scale than they might be able to with their personal funds. By aligning with a prop firm and implementing the higher time frame strategy, Traders can potentially meet stringent performance requirements and capitalize on the myriad benefits these firms offer. I actually personally recommend the Talented Trader, but I'm not gonna lie, their support ain't the best in terms of response time, because you kind of have to keep reminding them, hey, you know, what happened with this or what happened with that. But they're working on it. Okay, they're really active. I have seen payouts from them, so I would recommend you try starting off with them. Plus, they're pretty cheap. They offer MetaTrader for US traders and non-US traders. All right, so if you don't plan on trading with prop firms, you can literally skip all this part. This is only for people that are trading with prop firms. All right, so you know what? I'm not even gonna read all this. Now that I think about it, there's really no point in me reading all this. It's pretty straightforward stuff. All right, really straightforward stuff. If you actually want me to touch up on this, I'll touch up on it, but there's really nothing special about it here, guys. I have information on how to vet the prop firms. There's some prop firms that I would recommend you staying away from. What was that one prop firm that I got scammed out of? I forgot. It's like based in London. I'm pretty sure a lot of you have known. Please do your research on these prop firms, guys. Please do your research on them. Don't fall for any other crap that they give you. All right, just please be very careful, and please read over all of this. Please read over all of this. This is very, very important. Do not deviate from the main strategy highlights that I have pinpointed here, because I've backtested it a certain way and it's meant to be used a certain way. So try not to deviate from the original structure that I provided or formed the strategy in to begin with. Again, pause the video if you have to, and if you really do want me to go over it, then let me know. Let me know. Or if you have any questions on it, let me know down in the Discord. All right, so we are at the end of this video. Thank God. As always, guys, I'm gonna leave you with some little wisdom here from John chapter 8 verse 32. Then you will know the truth, and the truth will set you free. Guys, I've been doing my best to be honest with you guys, as transparent as I possibly can be. So please reward your brother with a like, subscribe, and a comment. Push me through these algorithms, y'all. Let's make sure we get as much of this content out there to the people that are already paying for courses. And quite frankly, they do not offer as much value as I give here to you. I mean, a lot of you have DM'd me saying that you have received a lot of value from my content, and I have not charged you guys a single penny. Okay, so with that being said, guys, if you have any questions on the strategy itself, anything that you want to know, hit me up on Discord, send me a DM, let me know in the chats, whatever. I'll do my best to answer. And yeah, guys, I pray that you guys become profitable traders with this strategy. I pray that you guys will be soon able to quit your 9-to-5s, get funded, and getting those payouts. So let me know how it goes for you guys down in the comments down below, and I will see you guys in the next one. Peace and God bless.